So, profits. Basically, we will discuss after seeing cost in the cost functions last class. We will now focus on profit maximization for firms in competitive markets. The things that most firms want to do. How to maximize your profits in such a way that you can grow and become a successful firm. Remember that last class, last week, we were discussing how to minimize costs. And the idea of minimizing costs is, well, I am a firm. I have this level of output that I want to target because I need this number of units for my store, or I have this number of clients that I wish to satisfy. So you have a target level of production Y. And the idea is, how do I select, buy, obtain, acquire, whatever you want to call it, different inputs that are necessary for my production or the production process of my firm, and how do I minimize the costs such that I can have the greatest of margins, or I am on the safe side with regards to the different prices, and be able to produce at a smaller level, or not be as preoccupied with the cost of different things, and not be as close to shutting down and stuff like that. Basically, that is what we were discussing last class, and you have all that information. So obviously, the level at which you want to produce is not necessarily only the place where your costs are minimized. Minimizing costs is really important, but for different levels of production, you can minimize costs. So if your target of production is 100,000 units, there is a way to minimize costs at that production level. If your production level, if you're a bigger firm and your production level is 1 million units, then there's also a specific level, a specific way at which you can minimize those costs. So obviously, where you should produce not necessarily coincides all the time with a particular position in which you are minimizing costs. You want to do that if you are a rational firm, but the underlying thing that has more importance is that depending on the degree of competitiveness of the market, the position where you maximize your profits, or the level of production at which you maximize your profits, changes. And that is something we will see after the midterm when we compare competitive markets, as in this class, with other forms of production like the more monopolistic type ways of producing. So basically, the degree of competition in a market, and specifically your size in that market, how dominant of a firm you are, how established of a brand you are, who are the top dogs of that industry, determines a lot where you produce. And this is a little bit of what we'll discuss this class. So we briefly mentioned this equation or this function last class, and it's the idea of the profit maximization function. So in economic textbooks, we use the Greek letter pi, in capitalized Greek letter pi, to symbolize profits. Profits depends on the particular production level, the output you produce, y, and they are composed of two things. They are the difference between your total revenues, and total revenues is literally just the number of units you sell times the price at which you sell them, P times Y, minus the total cost function that we saw last class or last week. And basically, you sum up all your revenues, and then you subtract all your costs, and that is basically your profits, just like that. The idea is, how do I maximize those profits? What is the particular level of production in which I get the greatest difference between my revenues and my costs? And that is where the cost minimization function enters the problem or the setup. So more or less, this is a little bit the idea of profit maximization. You have two functions, and what you're looking to find is the greatest difference between them. And as you can see, the blue function is your total cost, or C of Y, that we have discussed during last class. And it can take different shapes throughout the production of your firm, depending on, and that total cost function depends on the marginal cost and the average variable and average total cost that we discussed last class. The way those behave alter the way the total cost function moves, or at least the shape it has. And there are points in which your total cost will be higher, and there are points where they can be lower depending on the number of and level of inputs you use. And the total revenue tends to be much more linear in the sense that it's just literally like a multiplication of units sold times the price. So it's fairly linear. Obviously, if you can modify the different prices at which you're selling, and therefore that alters the particular multiplication, you could have increases in the slope of this red TR line. But in general, think of it, if the price more or less remains constant through it doesn't matter if you sell 1 unit or you sell 1 million units, then your revenues would be linear. Note, in real life, when you start growing as a firm, at the beginning, when you're selling 1,000 units and you're a small firm, your market share is so small in that particular industry that if you suddenly decided to shut down, or you went broke, or you disappeared from the face of the earth because aliens invaded or stuff like that, the overall industry would not get really affected by that. Therefore, the industry supply would not change. And if the industry supply curve doesn't shift like from the beginning of this course, then there is no change on the price. Your importance in that market is so small that it doesn't matter if you decide to expand 10% or decrease your production 10%. When you're a small firm, it is negligible for the industry or for the entire market, and therefore it will not change price. And therefore the assumption that the price is constant is a good assumption. The moment you become a much bigger firm and you are a dominant player in the market, or at least like the second biggest firm or something that is sizable, then the way you alter production, basically, if you expand production 10% or decrease it 10% or whatever, those those changes in production are so big that they actually make a dent and affect the overall industry supply. In those cases, your production would change, or your size of production would change the overall price. So the assumption of a constant price would not hold as much in real life when your firm has become a bigger firm. And that is the case where that straight line total revenue function would become more of like a kink, like the ones we saw at the beginning of the class. But in this case, the kink would go upwards in the sense that you would have like a straight line. There would come a point in which the price changes, and therefore, with a higher price, probably your total revenues would increase. So the steepness of the next part of the line would be bigger, and you would have like a step type function, or at least a piecewise function. But think of it as that most in competitive markets, most firms can't modify the price of the overall industry. Therefore, the constant linear total revenue assumption is a valid assumption. Questions of this long argument that I just explained? Very well. This is the same curve, same graph, sorry, as before, but now when you focus only on the profits, this is how you see where do you make a profit and where do you not. And this is why at certain points of your production, at your production level, you should shut down, as we discussed last class, or you should continue to expand. So look at, for example, the first, let's call it the first third or the first section of this graph, from the origin in the y-axis to the first dotted line, the first vertical dotted line. In the upper graph, the total costs are above your total revenues, which means that at that specific price, the total revenues, which are price times the number of units sold, is very small and can't cover the actual cost of production. Therefore, when you see the profits of that in the bottom graph, you see that the profits are negative. You are losing money. That third is before, or basically before the shutdown point that we discussed last class. And even before the break-even point, the first vertical dotted line, that where the bottom graph turns from negative to positive, that is where the break-even point appears, that we also discussed last class. Remember that the break-even point is the point where your marginal cost intersects the minimum of the average total cost, which means that at that point, your profits, at that price, your profits are zero, which implies that your total revenues were the same as your total cost. And that's the point where the blue line intersects with the blue curve intersects with the red line in the upper graph. From that, as you can see, your marginal cost keeps increasing, but your at that higher prices, your total revenues are bigger than your marginal cost and consequently than your total cost. Therefore, the revenues are bigger than the total cost, which implies a profit. And you are making profits at that point. That is the second, like let's call the second section of this graph. Obviously, there are different profits you are making, and what you want to do is produce the level at which you maximize those profits, which in this particular illustration or these graphs is the point at which the difference is biggest between the red line and the blue curve, which is more or less at the middle of that second section, and also at the middle where the plateau is in the profit function. And obviously, as you continue to produce, and we discussed this the last two classes, your variable costs start to increase because you need to hire more workers, you need to buy more inputs, maybe you ran out of the different inputs that you were buying from the first firm, so you need to find other firms. Basically, your costs start mounting up and adding up, and there comes a point in which those costs become also, again, too much, that eventually your total costs are the same as your total revenues, and then even could become higher than your total revenues because those costs are so big and you're not able to sell those many units, and therefore your total revenues have become smaller. At that point, you have reached the third section of this graph, in which once again your profits are negative. There is no specific name for this second turning point, but think of it, when you can't find so many clients that will buy your product at the specific price at which you are selling it, and yet because you have so many units, you are producing a lot, your costs increase, and those are the times when you basically accumulate inventories, when you produce more than what you actually needed to sell. Therefore, that production cost you money, and that's why the total cost increased from in that part. But you couldn't sell all those units. Therefore, your total revenues were smaller and could not keep up, and therefore you have negative profits. Questions on this further explanation of the same phenomenon we were discussing in the previous slide? Profit is maximized at that point. Your level of production, Y prime, whatever that number of units is, at that specific level of production, Y star, it is the point at which there is the greatest difference between your total revenues and your total costs. That difference is maximized there. Therefore, profits are maximized there. Economies of scale basically imply that you are able to ask for discounts from your input sellers, the firms from which you buy those inputs, in such a way that you obtain a better price. So you go and buy in wholesale, in mayoreo, like in the Central de Abastos, and you ask them for, like, you want so many tons of this unit that they give you a discount. If you bought only a couple of those units, if you were a very small firm, probably the price per unit would be higher than if you bulk buy and you have like a huge wholesale discount. And that's the type of thing that can also drop down the cost, the total cost function, when you are producing very big. With economies of scale, the firms that are able to pull that actually decrease their total cost as they continue to increase their production, because they are buying a bigger number of units from their inputs producers in such a way that those input producers are happy that they're making bigger sales, so they are willing to give you a better price even if they reduce a little bit their margins, because you're buying them so many units from them that they're happy, and they're gonna basically reduce your costs. That's called economies of scale, and that applies to basically any firm that can pull it off. But normally it is simpler to see in firms that behave more like natural monopolies, in which the increase in production actually decreases the cost in the average cost in the long run, rather than increase them as we saw last class. Questions regarding this point or these other points?